Guys, you must have seen so many people on the roads who drive cars, they don't have license. So these people who can drive the car but don't have the license, that means they don't know all the rules. So most of the time they are themselves confused on the road and they make others also confused. As a result, there are fatal accidents. Exactly the same way, there are so many people who know accounting but don't know all the rules, all the principles. So whether they are working in a company or there are students, they are always confused. They get stuck while they are doing their work. Today's session is based on accounting concepts and principles. What are the do's and don'ts of accounting? Which, if you know, it's like driving a car, having the license and knowing all the rules, so that you are safe, others are safe. So when you know accounting concept, principles and conventions, you will never get stuck, whether it be academics or whether it be your professional work. So I am the Commerce Specialist. Welcome to my YouTube channel. Let's jump into the discussion. Today I'm going to discuss the accounting concepts and principles. There are approximately 14. If you know them well, you will never get stuck. You will always be clear what to do, what not to do. So the very first one is concept of business entity. Concept of business entity is also known as concept of separate entity. What does this mean? From accounting point of view, business and the owner or owners are considered two separate entities. We are doing accounting for the business, not for the owner. Many students ask me about this when we give the entry, cash debit, capital credit. They say, why is cash debit? The money is going out of my pocket. I am investing. So my answer to them is, you're not doing accounting for the owner. You're doing accounting for the business. You're monitoring changes in the business. So if I am the owner, I'm investing money into the business. I have to look at what is happening in the business rather than what is happening in my pocket. I hope you understand. Business is considered a separate entity. So we are monitoring changes in business, whether assets are increasing or decreasing, liabilities are increasing or decreasing, revenues are increasing or decreasing, so on and so forth. So that's why this is the entry. Cash debit means increase in an asset in the business. Business is a separate entity. For this particular principle, concept of separate entity, we have an accounting title known as drawings. We operate this account to show when the owner takes out money or its equivalent from the business for personal use. Which means it is because of this principle, if you pay the salaries of the business, the official salaries of your office, the entry is salaries expense debit, and let's say you're paying for cash credit, let's say $10,000. So when you pay an official expense, a business expense, this is the entry, salaries expense debit, cash credit. So what if I am the owner, I am the sole trader, from my business cash, I am paying salary of my housemaid, personal housemaid, who's working in my house. Entry will not be salaries expense because salary expense shows it's a business expense. It's for the business. If it is personal, I will debit drawings and I credit cash. Let's say I paid $2,000. Now, debiting drawing means it's personal. It has nothing to do with the business. So please remember, according to concept of business entity, business and the owner or owners are treated as two separate identities. When we say asset, we mean assets of the business. When we say liability, we mean liability of the business. The owner may be a millionaire or a beggar, we don't care. Accounting is done for the business, not for the owner. I hope you understand this. Number two, the dual aspect. I studied sciences till my school. Most of you all must have heard about Newton's third law of motion. To every action, there is an equal opposite reaction. Likewise, in accounting, to every debit, there is an equal opposite credit. We also call it the dual aspect or principle of double entry. So please note, whenever you're recording a transaction, make sure you record both the aspect. Okay, cash in coming in. Why? It's an investment. Cash is going out. It's an expense. Cash is going out. Why? It's an expense. Cash is going out. Why? It's a personal expense. So please understand. Always record transaction, both the aspects of the transaction, the debit and the credit. Basically, it's why. For example, if I say cash debit, Cash debit 10,000 means cash came into the business, increase in asset. Now the question is why? Why cash is coming in? What is the reason? So it could be because of sales. We have made cash sales. It could be cash debit, account receivable credit, which means cash debit, cash coming in, account receivable credit means we have collected from the customers. Double entry. Not just what we are collecting from customer, the other asset, cash is also coming in. Not just the expense, also show that the cash is going out. Not just the personal expense, also show the cash is going out. Not that cash is coming in, the reason why it is coming in, it's an investment. I hope you guys understand principle of double entry. Coming to the third one, time period principle. Now think, what if a business starts its operations and after 4 years they prepare their financial statements? Statement of comprehensive income, which you call income statement, commonly known as income statement or profit and loss account. So if a business prepares profit and loss account after 4 years, and after 4 years they got to know that they've been running into a loss, it's too late, ladies and gentlemen. The time period principle says the financial statement should be prepared at least once in a year. And most of the time in so many jurisdictions, it's legal obligations. Especially for public limited companies, they have to prepare financial statement at least once in a year. Why? They have to disclose the results. They have to, report the results to the shareholders. Even if you're a sole trader, partnership or a public limited company, you have to declare your results. You have to prepare financial statement so that you arrive at a profit or a loss, whatever. In case of profit, you got to pay tax to Uncle Sam in US. Uncle Sam is the government of US. So, you cannot say that we started a business and it's been 3 years, we have not prepared financial statement. No way. You have to prepare financial statement once in an accounting period, which is 12 months. If you want, you can make it every month, every quarter, but minimum at least once in a year. The word is at least. Once in a year. You can make it every day, every month, every week. It's up to you. But at least once in a year. That's time period principle. Coming to the next one, cost principle. Cost principle means what? Cost principle says when we prepare statement of financial position, which you also call balance sheet, most of the non-current assets, which you call fixed assets, are to be recorded at their historical cost less accumulated depreciation. Let's assume this is the statement of financial position of a company as at December 31st, 2019. Okay, so you got assets, you got non-current assets. Under non-current assets, let's say you have a building, let's say 400 million. This 400 million, according to cost principle, this is the historic cost. Let's say you purchased this building 10 years back for 400 million. And then you subtract accumulated depreciation. That means accumulated depreciation from the date of purchase till this date. Let's say it's 100 million. You subtract this 300 million is known as net book value or value after depreciation. This is what the cost principle says. All non-current assets to be recorded in the statement of financial position at their historical cost. Here you need to understand 95% of the times we do this cost principle. Unless the net book value, this is also known as carrying value. Unless the net book value or the carrying value is way different from the market value, which we call fair value. And if that is the case, if there is a material difference, if there is a substantial difference between net book value, carrying value and the market value, then as per IAS 16, we are supposed to revalue the asset. But that's a different discussion altogether. I have already discussed that in one of my videos already. That's on YouTube. IAS 16 depreciation, property, plant and equipment. There I've gone into detail how we revalue. But for now, when it comes to cost principle, keep in mind all non-current assets are primarily recorded in the statement of financial position, which is balance sheet, at their historical cost. Not the market value, not any other value. Next, concept of going concern. What is going concern? What is the assumption? What is the concept of going concern? The going concern assumption is, it is the assumption that the business will continue to operate in the foreseeable future, which means we have no plan to shut down. Business is a going concern means in the near future we have no plans to shut down. We will continue to operate whatever we are doing. So why is this principle important? We have Accounting Standard 1, IS 1, which relates to going concern as well. IS 1, International Accounting Standard 1, gives us the guidelines to prepare financial statements. And it says, generally, whenever you prepare statement of financial position, in particular, going concern assumption is to be followed. What does this mean? If the business continue to operate in the foreseeable future, that means they require the non-current assets. If they require the non-current assets, they are not interested about the market value. That's why it is recorded at historical cost. See the connection. Going concern and cost principle, they are connected. Because cost principle says non-current assets are to be recorded at their historical cost, the cost at which we purchased. Going concern says that the business will continue to operate in the foreseeable future. Foreseeable future means next 12 months. We cannot give the guarantee for the whole life for 20 years. At least we have no plans to close down in the next 12 months. That's going concern. So if the business has no plans to close down, why would they be interested in the market value of their assets? Because assets are to be used in the business rather than to be sold. Other than inventory. I'm not talking about inventory. I'm talking about non-current assets. That's what's going concern. If the business is a going concern, financial statements should be prepared keeping in mind going concern. That means non-current assets should be recorded at historical cost, not their market value. But what if the business is not a going concern? The business is in severe financial difficulty and is about to close down in the near future. Then they are not supposed to prepare financial statement on the basis of going concern. Instead, financial statements, especially the statement of financial position, will be prepared on a breakup basis. Breakup basis means we are not going to show net book value, rather we are going to show the market value of non-current assets. Why? Because the business is going to wind up. If we are going to wind up, we are going to sell the asset. If we are going to sell the asset, we are interested in the market value. Another important aspect of breakup basis is when the business is not a going concern, we don't have non-current liabilities in the business. Non-current liabilities turn into current liabilities. Why? Because the business is closing down. We need to pay everything right now. We need to settle the accounts. Next, ladies and gentlemen, very important. And I wrote here ISA 570. Look, IAS is International Accounting Standard, which tells us the do's and don'ts of financial accounting. ISA is International Standard on Auditing. Coincidentally and fortunately and unfortunately, I don't know, but I've been teaching audit and advanced audit for more than 15 years now. And just to add it to your knowledge, recently one of my students has topped the whole Oman in advanced audit paper. So why I wrote this here is, we also have an auditing standard. As an auditor, if I go into a firm to audit, my audit client, let's say it's a bank. When I go to audit a bank, I am the auditor, bank is my client. Among so many things, it is my duty to report on the going concern status to the stakeholders. When I prepare my audit report, part of the audit report, one section of the audit report is auditor's opinion on going concern status. As an auditor, I am going to tell any and everybody who's interested into the affairs of the company whether this company is going to survive next 12 months or not. Soon I'm going to make a video on a few topics of audit also. I'm receiving so many requests. Hopefully soon my videos on auditing will also be on air. So coming to principle of consistency. Consistency means accounting concepts, principles, Methods, once chosen, should not be changed very frequently. What does this mean? For example, have a look at this. See, accumulated depreciation. That means you must have used a depreciation method. For example, the most common, straight line. So in your company, if you have decided, after careful analysis, if you have chosen to use straight line method, then every year you should be depreciating your assets with straight line method. You can't use straight line in 1 year, declining balance in the second year, third year, some of the years, and acres, makers, double declining. You can't do that. Another example I gave you, like if I talk about current assets, we've got inventory, okay, you call it closing stock. You know there are stock valuation methods. First in, first out, average costing. Last in, first out is no more used. IS2, which is inventory valuation, which discourages us from using last in, first out. So let's say if the company is using first in, first out method to value their closing stock, they should continue to do this unless it is very important to change the method. So if there is no dire need, no urgency, there is no rationale to change the method, a company should use the same method, whether it be for inventory valuation or for calculation of depreciation over the years. Now the question is why it is so important. Why it is important to be consistent. If you're using a year 1 first in, first out, year 2, year 3, year 4, you should be using first in, first out method. Why? Why can't you change? You cannot change because just by changing a method from first in, first out to average costing, from straight line to declining balance, you can convert profit into losses, losses into profit. And that will come under the meaning of creative accounting, which you call, cooking the books. That is more known as window dressing. We don't want to fool the shareholders. We know that we are going into losses. Why not change the method? Sometimes, and most of the time, just by changing depreciation method, you can convert possible losses into profit. Actually, these are not profit. Just by changing the method, you are just, giving a false presentation to the stakeholders, which is not allowed. Now, you should be thinking, does that mean we cannot change depreciation method or inventory valuation method? No, I did not say you cannot. It is not suggested and recommended. But what if there is a dire need? The circumstances are changing. What if we were selling perishable items? We were in trading business. We were selling fruits and vegetables. These are perishable items. We have to use first in, first out for perishable items, items which have expiry. But what if now we are moving into durable items? We can use average costing. But if you do that, here comes the principle of adequate disclosure. If you are changing accounting policies, procedures this year onwards, you have to disclose that in the notes to the financial statements. How it is? I'm giving an example. Till today, till this year, 2020-21, we have been using the straight line method to calculate depreciation and first in, first out method to calculate inventories. But the company has plans to use declining balance method instead of straight line and weighted average method instead of first in, first out in the upcoming years. So that anybody who understands accounting can see if there is a change in profit. Let's say profit has changed 20%. They will be able to understand how much of the change is contributed because of change of method. So if you eliminate that, you'll get to know the real change and which is the performance of the company, not because of the change of the method. Next, ladies and gentlemen, materiality. Very important one. Equally applied in auditing, equally applied in financial accounting as well as in management accounting. The whole word is actually principle of materiality and aggregation. The whole principle is like this. The name is principle of materiality and aggregation. What does this mean? Material does not mean this, cotton. English meaning of material is, this material or maybe raw material. Material in accounting and audit means something significant, something important. For example, if you purchase equipment, so the entry would be like this: equipment debit, let's say $50,000, and you're paying cash, you credit cash. So guys, why did we debit equipment? Debiting equipment means we are recognizing this as a non-current asset. We're recording it as a non-current asset, which means later on we are going to calculate depreciation on the equipment. Let's say another 5 years. But what if we purchase pencil for $1? I'm not going to give this entry, ladies and gentlemen. No way. Because if I debit pencil, that means I'm taking it as a non-current asset. Do you think we are going to calculate depreciation on a $1 pencil for a number of years? We have chartered accountants, we have management accountants, we have professional accountants in companies. We have to take important work from them. We can't just pay them thousands of dollars and tell them to calculate depreciation on a $1 pen for another 5 years. Instead, what we do, either you record it as stationery and credit cash, taking it as a current asset, or else instead of this you can also record it like this. You write miscellaneous expense or general expense or sundries expense and credit cash. So let's suppose if you're paying salaries, I gave you before also, salaries expense debit, cash credit. If you're paying rent, rent expense debit, cash credit. Look, salaries expense, rent expense, we are maintaining individual accounts because these are huge expenses. These are material. These are huge in dollar value. But if you pay $1, to a beggar, you're not going to record beggar expense debit cash credit because that is so small, that is immaterial. If it is immaterial, all immaterial items are to be aggregated in one account, which is miscellaneous expense. Small, petty, so many expenses you will do. You will not make a separate T account for all the expenses. Beggar expense debit, this expense debit, no. Instead, you're going to aggregate them. That's the meaning of this principle of materiality. The whole title of this principle is Principle of Materiality and Aggregation, which means small items, immaterial items are to be aggregated rather than creating a separate account for them. Another example for materiality is when we calculate depreciation. You must have seen we calculate depreciation. Sometimes we calculate for 9/12, that means for 9 months. Sometimes for 3/12, that means 3 months. Have you ever calculated depreciation for 3 days? The answer is no. Let's say if you're buying a machine on January 5th and the year ends on December 31st, you're going to calculate full year depreciation. Full year means for 12 months. But if you're buying the machine for January 20th, which is after the 15th, you're going to calculate depreciation for 11 months because you're not going to consider 10 months of January, 10 days of January. 10 days are immaterial. So please remember, for depreciation, that's a classic example of principle of materiality. If it is purchased on 5th of January, it is considered as if purchased on January 1st. If it's purchased on 20th, don't consider this month because we will not calculate 10. We will assume as if the machine is being used from February to December. Okay? Principle of prudence, also known as conservatism. So in some of the books, most of the ACCA books, CIMA books, you will find the word prudence. But in CMA and CPA books, you will find conservatism. What is prudence or conservatism? Principle of prudence says assumption of the worst. As per principle of conservatism or prudence, that means it says future losses are to be immediately recorded, but future gains are only recorded when they materialize. One of the classic example of principle of conservatism is bad debts. Bad debts is a future loss. Let's say you sold a customer some goods on credit on the 15th of December. Your year ends on December 31st. Okay? Your year ends on December 31st, and when you sold the customer, you gave him 60 days. You gave the customer 60 days to pay. So from 15th of December to 30th of December, it's only 15 days. But at year end, we make the adjustment. We make the adjustment for bad debts. Although we will only get to know after 60 days whether the customer will pay us or not. But being prudent, because we've been doing business for 20 years, every year there is 10% bad debts. So if the amount of sales is 20,000, we will assume 10% bad debts and we record 2,000 bad debts at year end. Even 60 days are not over. Even his account has not matured. Even the due date has not come. This is one example. Future losses are to be immediately recorded. Another application of principle of prudence is in IS2. Inventories. It says inventory should be recorded at cost or NRV, whichever is lower. So let's suppose I'm dealing in cars. I purchased a car for 10,000. NRV basically is selling price minus expenses necessary to sell. So if I purchase a car for 10,000, selling price could be 14,000, but expenses necessary to sell will be 6, for example. Unless I spend 6,000, I cannot sell the car for 14. So if I spend 6,000 and then sell the car for 14, 14 minus 6, my NRV is 8. So my cost is 10, NRV is 8. According to IS2, inventory should be valued at lower of cost or NRV. Why lower? Being prudent. So I know I purchased a car for 10,000 and in future it will be sold for 14, but I have to pay 6,000. So how much I would get? 8. Which is lower? 8. Now 8 shows a future loss of 2,000. I have to record inventory at 8,000 in my statement of financial position. Future losses to be immediately recorded. IS2 cost or NRV is a classic example of this. Calculation of bad debts is a classic example of being prudent. We are recording bad debts before time. I hope you guys understand this. Ladies and gentlemen, the next one, the 10th one, is substance over form. The full name of this principle is economic substance over legal form. So economic and legality. We are talking about the economic aspect, the legal aspect. Now, one simple example which I always give, assuming you are a company and you have taken a car on lease from a bank. Now my question is this car which you have taken from a lease, actually you have not paid a single penny, no down payment. The value of the car is, let's say, $20,000. You have financed a car, you have taken a car on lease from a bank, paying 0 down. This car, now you got to answer me in one word. Is this car your asset or is this car your liability? The value of the car is 20,000. You're not paying a single penny. Think about it. One word answer. Don't tell me it is an asset or a liability also. One word asset. If I ask you to choose one word, will it be an asset or a liability? Here comes the application of this. Substance over form. Substance means the economic substance, the economic reality is given more importance in accounting than the legal reality. We are studying accounting. We'll give more importance to the economic reality. Economic reality is, even if you have not paid a single dollar to the bank, whose possession the asset is in now? We have the asset. The business has the asset. We can use it. We can use it to produce future profits, which means it's an asset. It's a resource of a business. Had we been students of law, if we are not talking about accounting, we are talking about law, then the legal aspect is more important. In law, we always look at who has the legal title of the car. And the reality is the bank has the legal title of the car. You cannot sell the car without permission, NOC from the bank. So bottom line is, in accounting, we give more preference, more weightage to the economic aspect of a transaction rather than the legal aspect. And for that reason, for leasing, we have, earlier we had IAS 17 leasing. Now it has been changed to IFRS. I think it's IFRS 15. Yes, revenue from contract from customers. Earlier we used to have finance and operating lease. Now it says there is no two different lease. There is only finance lease. Because people used to do off-balance sheet financing. You can go into the detail, that's not a topic now. But bottom line is, when we talk about substance over form means substance is given more importance over the legal form. Economic substance. In accounting, economic aspect is what we are looking at, not the legal aspect. Next, the monetary aspect. Very, very important. See, if I record furniture debit and bank credit, 10,000. This means furniture has been purchased and payment has been made through a check. That's why I credit bank. Furniture debit, which means increase in asset. Bank credit, that means decrease in asset. But still there is something missing in this transaction. What is missing? The application of monetary aspect. The monetary aspect of money measurement says, first of all, only those transactions should be recorded in the accounting records, the ones which can be measured. So only those transactions should be recorded which can be measured in terms of money, which can be quantified. Alright, it is quantified, 10,000. Furniture is for 10,000. Now the next question is, what is the monetary aspect? Is it dollar? Is it pounds? Is it Deutschmark? Is it Italian lira? Is it real? Is it dinar? Is it Pax rupees? It is US dollar? It is Great Britain pounds? What it is? Because 10,000 can mean anything. It can be 10,000. $10,000 is way different than 10,000 euros. So we do not record a transaction, number one, unless we are able to measure it in terms of money. We are able to quantify in terms of money, and we know the unit of the currency. Dollars, pounds, Deutschmark, so on and so forth. Next, objective evidence. This has happened so many times with me in my early career, working in company like accountant, senior accountant, junior accountant, whatever. And I learned it through the difficult way, the hard way. For you, I'm just presenting in a plate. Simple. If you're working in an accounting and finance function, please do not record any transaction. Do not record any transaction unless you have a supporting documentary evidence of the transaction. Like furniture purchase, if somebody asks me to record this transaction, I will ask for two things. Number one, where is the purchase invoice? If you have purchased the furniture, I want to know where the furniture has been purchased and it is for $10,000. Number two, if you have made payment through bank, give me a copy of the check. How would I know whether the payment has been made through a check or cash? If it is cash, give me the receipt. Customer must have signed the receipt. So that will save you long way in your accounting career. Never record a transaction without supporting document. If you're depositing money in the bank, let's say the entry is like this: bank debit, cash credit. If I'm the accountant, somebody tells me, yes, we have deposited money in the bank, please give an entry. I'm not going to record unless I get the deposit slips copy, or if it's an online transaction, the transaction record. There is a summary of the transaction. Unless I get supporting document, I'm not recording this. Because recording this transaction, let's say it is 50,000 US dollars. So if as an accountant you're recording this transaction, bank debit, cash credit means assuming you had this much money in the office, $100,000. Giving this entry means you are saying that 50,000 has gone in the bank and you are left with 50,000 in the office. Your bosses can question you. Where is the other 50,000? I have given this entry. What if somebody has taken the money? They've gone home. They pocketed the money. and you are showing that this much has gone in the bank. Do I have the proof? So I'm not going to give this entry, I'm not going to record this entry unless I get the bank deposit slip or any evidence from the bank that the money has been deposited. That's, ladies and gentlemen, objective evidence, supporting evidence. In audit, we call it sufficient appropriate audit evidence. As auditors, when we say something, before giving our opinion, we collect sufficient appropriate audit evidence. In accounting, we don't record a transaction unless we have a supporting documentary proof. An invoice, a journal voucher, a receipt, a credit note, a purchase order, anything, a supporting document which supports the transaction has taken place. Next, matching principle. Now when we say matching principle, the full name of the principle is matching cost with revenues. And matching principle is very important when we prepare financial statements. Matching principle says in order to calculate profit or losses of a particular accounting period, you have to consider all the revenues relating to that accounting period and all the costs and expenses of that accounting period. Only then accurate and correct profit for that period can be calculated. I give you an example. Assuming we are preparing statement of comprehensive income, like income statement. We can call it income statement. The proper word is statement of comprehensive income. So you have sales for the year, 50,000. You have cost of goods sold, let's say 10,000. You got gross profit, which is 40,000. And let's say the only expense is rent. And the information given to you is annual rent is $12,000. Rent paid so far is $8,000. So my question is, if you're preparing statement of comprehensive income, which is the income statement, your only expense is rent, how much rent should come here? The annual rent is 12, but you have only paid 8,000. Some people say, because we have paid 8,000, we should take 8,000, and that's being fair. We are not talking about what is being fair. We are talking about what is right. What we are supposed to do. If this sales, and you must have seen, when you look at the statement of comprehensive income, below that it's written for the year ended. Means this sales is for the whole year from January to December. So according to matching principle, if we are taking revenue for the full year, we have to take expenses for the full year, whether paid or not. So how you write rent here is, you would write here like this, 8,000 is paid plus 4,000 is accrued. Accrued means due. So you will take 12,000. And then let's say you have a net profit whatever. You're not going to take 8,000 because you have paid only 8,000. What you have paid, that doesn't matter. What matters in the statement of comprehensive income is what is rent for the whole year. Even if you have not paid a single dollar, still you will take 12,000 here. In the statement of comprehensive income, let's say the annual rent is 12 and you have not paid anything. Paid 0, nothing is paid. Still you will take 12,000 as an expense, but because that's an expense for the year, whether paid or not, that's a different debate. So when you're making financial statements, rent for the whole year is 12. If you have not paid anything, you will still take 12,000 in the statement of comprehensive income. And when you make the statement of financial position, which is the balance sheet, you will take in your current liabilities, rent payable or accrued rent or rent outstanding, 12. So that gives the double entry. You are recording rent for the year, and in the balance sheet, if you look at, it shows rent payable 12. That means it is still to be paid. Another example of matching principle. Same, rent for the whole year is 12,000. Rent for the whole year is 12,000. Annual rent is 12,000. And because the company has a lot of money at disposal, or maybe they were going nuts, so they paid rent, annual rent is 12, but they have paid 20,000. So a normal person would say, okay, we have paid 20,000 as expense, cash has gone 20,000, so we should be taking rent as 20. The answer is no. Because this statement of comprehensive income is for a year, let's say from January to December, you need to match your expenses with that year. So what is the expenses relating to this particular year for which we are making this? That's only 12. So rent over here will come 12, even if you are paid 20, and whatever your profit comes. But when you make statement of financial position, or you call it balance sheet, there among assets you will have prepaid rent. Because the rent for the year is 12, you have paid 20, so 8,000 is prepaid. That will go as a current asset. And here you will show like this: 20,000 you have paid minus 8,000 prepaid. 12,000 is the rent for the year. Because of matching principle, ladies and gentlemen, you have accruals and prepayments, especially in F3 of ACCA, financial accounting. There is a chapter in detail on accrual and prepayments. And the crux of that chapter is you need to understand matching principle. If you are calculating profit for the year, you have to consider all the expenses, all the incomes and revenues for that particular year. If you have paid anything in advance, that should be subtracted as prepaid. If the expenses for the whole year is 12, you have only paid 1,000, still you will take 12. The remaining 11,000 will go as an accrual, as a rent payable of rent outstanding in the balance sheet, as a current liability. In the end, we are talking about, as I said, accrual is also related here. We are talking about realization, principle of realization. It says revenues, incomes like this, 50,000, should be recorded and recognized when it is earned rather than when cash is received. This could be a credit sales. So recording revenue does not mean that you will only record revenue when cash is received. Receipt and payment of cash has no importance here. What is important is, for example, I've sold the goods to the customer, I've done my part, I have earned the revenue. Customer has not paid, so that's a receivable for me. So if I've already sold the goods, I will record credit sales. I will not wait to record sales unless the customer pays me. That is cash basis of accounting. 99% of the time accounting is done on accrual basis, which means revenue should be recorded when it is earned rather than when cash is received. Likewise, expenses should be recorded when they are incurred rather than when cash is paid. So ladies and gentlemen, these are some of the principles of accounting. I tried my best to explain as much as I can. If you still have any query relating to any of these principles, please put your queries in the comment section. I will respond to that. If you like this video, please give me a thumbs up. Don't forget to press the bell icon so that you keep getting my videos on a timely basis. And if you like this video, please share it with your friend and family members, dear and near ones, so that others can also benefit. Thank you so very much for your precious time.